The Federal Reserve has indeed made a significant move by cutting interest rates by 50 basis points for the first time since 2020. Here are the key points from their recent announcement. The Fed cut rates by 50 basis points, bringing the federal funds rate to a range of 4.75% to 5%. They anticipate two more 25 basis points rate cuts in 2024. One Fed governor dissented, preferring a 25 basis points rate cut. The Fed has gained greater confidence that inflation is moving towards their 2% target. They will carefully assess incoming data and adjust their outlook accordingly. The Fed projects 100 basis points of rate cuts in 2025 and 50 basis points of cuts in 2026. This move reflects the Fed's strategy to balance inflation control with economic growth. The Federal Reserve's decision to cut interest rates has several implications for the economy and financial markets. Lower interest rates reduce the cost of borrowing for consumers and businesses. This can lead to increased spending on big-ticket items like homes and cars, as well as more business investments. By making borrowing cheaper, the Fed aims to stimulate economic growth. This can help counteract slowdowns and support job creation. The Fed's confidence that inflation is moving towards its 2% target suggests that they believe these rate cuts won't lead to runaway inflation. However, they will continue to monitor economic data closely. Lower interest rates can be positive for the stock market. Cheaper borrowing costs can boost corporate profits, and investors might shift from bonds to stocks in search of higher returns. Interest rate cuts generally lead to lower yields on bonds. Existing bonds with higher rates become more valuable, but new bonds will offer lower returns. Lower interest rates can weaken the dollar, making US exports more competitive, but also potentially increasing the cost of imports. On the downside, lower interest rates mean lower returns on savings accounts and fixed income investments, which can impact retirees and conservative investors. Here are some sectors that typically benefit from lower interest rates. Real estate. Lower mortgage rates can boost home sales and construction activity, benefiting home builders and real estate companies. Consumer discretionary. With cheaper loans, consumers are more likely to spend on non-essential items like cars, electronics, and luxury goods. Financials. While banks might see a reduction in net interest margins, other financial services like mortgage lenders and asset managers can benefit from increased borrowing and investment activity. Utilities. These companies often carry significant debt, so lower interest rates reduce their borrowing costs, improving profitability. Technology tech companies, especially those in growth phases, often rely on borrowing to fund innovation and expansion. Lower rates make this cheaper. Consumer staples. Lower rates can increase consumer spending power, benefiting companies that produce everyday goods. Understanding these implications can help you make informed decisions about your investments and financial strategies.